Welcome. My name is Van Richards. I'm a chartered financial consultant, and today I am talking about a company that is actually making profits from climate change. Now, that's not a bad thing, but it's actually a good thing the way that they're helping the world in itself. What I'm talking about today is Munich RE. So let's go ahead and begin today with today's daily stock analysis. Thank you for joining me today. If this is your very first time to tune in to YouTube or to listen on one of the podcasts, make sure that you subscribe to YouTube. Make sure that you follow me on whatever podcast platform that you're utilizing. I come to you almost every day with really good information. My goal is to help you to make it simpler in picking stocks. I've got a process and I want to share it with you, and I'm going to use it with the information that I have today. Now, when I picked Munich RE, one of the reasons why I picked it is because it was one of the stocks that was in a Barron's article from last weekend. We'll talk about that in a minute. But as I dug into it just a little bit more, it's complicated. But I thought, I can't come to people that watch this or listen to this and give them all this gobbledygook that's out there because it's just too confusing. So what I'm going to attempt to do today, and hopefully I succeed, is give you some parameters in how you could use the information that's available to ascertain whether that this is going to be a good stock for you or not. And let's go ahead and begin talking about it just a little bit. Before I begin into it, I want to remind you that today's sponsor is Richards Financial Planning. That's my firm. If you're frustrated with your finances, if you're looking for direction and help, go to richardsfinancialplanning.com. There's a whole lot of good information there. The most important thing that you'll learn about is going to be the prosperous planning process. Now, I'm also going to remind you as I go into talking about the company that we're talking about today, which is Munich RE, there's limitations to the information that I'm able to supply you with. So stay tuned at the end of today's program. If you're watching, I have disclosures that are going to come up on the screen that are important. If you're listening on the podcast, hang on for just a minute and I'll explain those at the very end of today. So let's break down what's going on with Munich RE, and hopefully I can make it a little bit simpler for you to understand. This is a really, really good company. They're 140 years old. The company in itself is really broken up into two primary divisions. Munich RE is reinsurance. We're going to talk about that in just a moment. But the traditional side, which is more of a business to consumer company, is Ergo. Now, the company's profits are mainly lying in Munich RE. They had $45.15 billion in premium in the last year in 2019. That's about 68% of the company's premium. In the Ergo portion of the company, they had around 21.48 billion, which is about 32%. The total premium for the company was about $66 billion. Now, you notice I'm talking to you today about it a little bit differently than I have in days past. In days past, I might have spoken about revenue in general. Now, I'm going to talk about profits too, but the way that Munich RE's profits are driven is based on the premiums that it's bringing in. The company, it's a reinsurance company, which is different than what you might be thinking of when you're thinking of like State Farm Insurance or another insurance company that's out there. Companies that are traditional insurance companies utilize companies like Munich RE. Munich RE is a reinsurance company. Now, it's important that you understand what a reinsurance company actually does. The company it buys risk from other insurance companies. Now, I have an icon that I use, and if you're watching, you see it thrown up on the screen. The icon is a group of business people with a big umbrella over them. And then they have another big umbrella over top of that. The big umbrella over top of everything is the reinsurance. Let's say, for example, that a famous person, let's pick whoever you want to, whether it's going to be a political figure or a movie star or something like that. Let's say there's some movie star out there that wants to buy life insurance, and they want to buy $500 million worth of life insurance. Well, one insurance company might think, that's great that we've got this policy that we're going to sell to this person, but what happens if they actually die? $500 million is a lot of money. So what they will do is they will go to other companies like Munich RE, and Munich RE will participate in that risk with them. The same thing occurs with, they might insure a crop for a particular large farm organization, or they might insure a building. Let's say, for example, if someone had the Khalifa Tower and they wanted to insure the whole thing, it might be worth billions of dollars, but one insurance company can't take all of that risk. So they group it together and they buy the risk from each other. Reinsurance companies, you really don't hear a lot about them because they actually operate in the background. You're never going to see a commercial for a reinsurance company. Now, Munich RE in the United States, we would classify this as an international company. And what I've done is I've thrown up a screenshot. If you're watching, I'm going to describe this to you for those of you that are listening too. I use a strategy that's called the modern portfolio theory, and I allocate money in different areas in different percentages. If you're going to be investing more conservatively, as you can see that's in the screenshot that's been put in front of you, short-term bonds might be predominantly the investment if I have a very conservative allocation. On the other hand, if I'm going to be more aggressive, I'm going to have more money that's going to be invested in stocks. Now, I want to tell, the reason why I put this up here is I want to tell you about a misconception that's out there, and that's about international stocks. If you're outside the United States, you might not have heard of this, or you might not be thinking of it quite as much. If you're working for a company and you've got a 401k, or you've got an investment, you might have been told international investments are risky. You need to put less money in there. I think that is incorrect in the way that it's described to you. The reason is you're going to have a company like Munich RE that I'm going to show you is a very dependable, conservatively managed company. It's not in the same ballpark as a publicly traded IT company that's in South America. Now, nothing against the publicly traded IT company that's in South America, maybe with 12 employees, but that's different as an international company when you compare it to something like Munich RE that has around 39,000 employees, and they have offices all around the world. So don't be drawn into the misconception that international investing is all going to be risky. It's not. You need to break it down into international developed stocks and international emerging stocks. Munich RE, from the United States standpoint, would be considered international developed stocks, and it would be on the same par of risk as a large cap GARP stock. Now, what's a GARP stock? Growth at a reasonable price. Some people might call it a value stock, or large cap growth stocks. So if you're just listening to this, go over to the YouTube channel and you can see the graph that I put up and get a screenshot. I think that you might find that is very useful. But let's go a little bit further and talk about how this company fits the criteria that I set out every day, and that is we look at the SEC method that I've developed. We look for a company's stability, we look for their earnings, and we look at their competitiveness. And if they fit those three criteria, then it is a good candidate for a lot of different reasons. You're the person as the investor that will determine what reasons that would be. Now, usually when I get to this part of the program, I'll talk about the moat of a company. Remember, the moat is that invisible barrier that's between the company and their competitors. Now, if you go to some analysts like Morningstar, Morningstar actually says that this company does not have a moat. I think they're wrong. And the reason why I picked a narrow moat is because of this. This company does have proprietary assets from the standpoint of they have brand goodwill. They are significantly recognized throughout the world when a company is looking for a reinsurance company. They'll go Munich RE. They also have a significant base of loyal customers. The size of the company makes a big advantage too. Now, here's a third point that I put in as a moat characteristic that you might not hear anywhere else. When we look at Munich RE is actually considered an oligopoly. Now, what's that mean? An oligopoly is a business that there's only a few of them. There's not a lot of competition, and most of the businesses that are in an oligopoly market are going to be those that all of them profit, but not one is predominant over top of the other. So those are significant narrow moat characteristics. Now, usually when I get to this point of the presentation, what I'm doing is I'm talking about the earnings more. I've talked about the stability. Now we talk about earnings. The way that we do that in talking about Munich RE is we're going to go back over the past 10 years and we're going to look at their revenues in euros. And what I put on the screen in front of you for those that are watching and for those that are listening, let me describe this to you. I went back to 2010 and I looked at the fact that they had revenues of around 64 billion euros. And it's been pretty close in between 64 and 61 billion euros from 2010 to 2019. And if you look at some of the down years, like in 2011, it was around 60 billion euros, and in 2018, it was 55 billion. Those years, if you take those out as anomalies, you'll see that they have pretty consistent earnings. Now, another thing, always I put this up here, remember that even though that I'm talking about this company's past, its past is never going to be a guarantee of what's happening in the future. So how did they translate that consistent earning stream into income? Well, we do the same thing. We transfer this over into net income and we look at the averages and we take out the outliers. In other words, take out 2011, take out 2017, which had net income of around 712 euros and 375 million euros. That was 2011, 2017. Take those out, and you're going to see that the average is around 3 billion euros per year on a regular basis. They have a very steady income. But remember, we can't use that as a perfect judge toward the future. So what did it do in those down years? Remember 2011 and 2017? Well, I put up the spaghetti graph in front of you. And what you can see is if you look at 2017, there was hardly anything going on with the price. And if we looked at 2018, the stock's value continued to grow. If we look at it historically and we go back on the price, let's go back just a little bit more. All right. The other reason why that we're seeing this increase and we're seeing this steady increase in value is the solvency ratio. Even though the value of the stock is continuing to grow, and we're seeing things like earnings that have down years and revenues that have down years, the big significant thing is that this company's solvency ratio is over 200%. And that's a big deal. What's that mean? It means that if they sold all their assets, they have basically 200% more value than what they owe. Now, that's a very simplistic explanation, but that's basically the way that it works. So the solvency ratio is what's keeping this company going. And here's the best part, my friends. Here's the best result for you if you're a shareholder, and that's the dividends. They have a 3.87%. And I love dividends. I think that they're one of the best parts of an investment. Now, when we're looking at a dividend in itself, how does that help a company grow? The company over a period of years, let's go back to 2010 again, and we're talking about this in euros for just a minute. In 2010, it had 0.41 euros per share. In 2019, it had grown to 0.92 euros per share. Now, if you're looking at the graph that's in front of you, it's interesting because it's a stair step every single year as it goes along. The most significant thing, I think, about the dividend for Munich RE is the last time that Munich RE lowered its dividend was in 1970. They try every year as they can to increase the dividends. Now, always remember, dividends are not going to be guaranteed. So the past performance is not going to be a guarantee of what the future results is going to be. Now, when we look at as a percentage of the share value, right now we know that they have a current dividend rate of about 3.87. That's based on the fact that this company tries to pay out its ratio, its earnings, at least 50% of that on an annual basis. Back in 2014, they didn't make it. They were only paying out about 5.12% of their earnings, but they had a 5.06% dividend. And then throughout the years, they've had higher payouts and lower payouts. But the point is going to be that they've paid consistent dividends every single year. Right now, they're paying that 3.87% dividend that's out there. Again, I have to always remind this to you that are listening and watching, the past performance can't guarantee what the future is going to be. Now, for you that are the investors, you have two choices when you're picking an investment. And the way that you should look at Munich RE is this. It is a company that grows significantly based on its dividend earnings. And you have a choice when you are buying an investment to buy an investment that's going to grow based on capital gains, which is primarily influenced by the markets, or one that grows based on the dividends, which is not only going to be influenced by the markets, but it's going to be influenced by management practices. The management, as I've mentioned before, has tried consistently every year to increase the dividends. And as I mentioned again, you can't have guarantees on dividends, but they haven't reduced their dividends since 1970. So that's a pretty good history. Let's look at actually what's happened on the value of the stock. In the past year, I think that it's been unfairly hit by what's going on in the market, but we have to also look at it from the standpoint that the value is going to be affected by what's going on in the economy with the pandemic. A year ago, if we get in the Wayback Machine and we look at this, a year ago, the price of the stock was at $28.41, close to $28.42. Today, it actually ended at $26.95. I put on the screen here 27.02, but it shows that it's really down about 5% for the year. Remember, though, that is an isolated number away from the dividend. It's paying dividends in spite of the fact that it's had a loss in value. And again, we have to remember that the past performance can't guarantee what's going on in the future. Now, talking about the future just a little bit, let's talk about guidance, because Munich RE actually withdrew its guidance about the first quarter, into the first quarter, going into right at the height of the pandemic. They withdrew their earnings guidance because they could not anticipate what the growth was going to be. Now, here's a quote that came from the company. They anticipate profits in the low three-digit million euro range for the first 3 months of 2020. Now, if you compare that, you have low profits. If you compare it back to the first quarter of 2019, their profits were around 633 million euros. So we have to take that into consideration when we're looking at the valuation of the company on a long-term basis. Now, insurance is a sponsor for the program. It has nothing to do with Munich RE, but today's sponsor, I want to take just a moment and emphasize, and that is advice for life insurance. Your family needs life insurance. You can protect them with life insurance by going to adviceforlifeinsurance.com, and you can find great rates and great policies. You can find the best life insurance at the lowest price in less than 5 minutes. Now, let's talk a little bit more about some of the opinions that are coming out on Munich RE. Now, I picked this stock because it was one of the ones that was listed in Barron's roundtable. There were 28 investment ideas that came from their roundtable over the weekend, and this is one of the ones from RuPaul Benswali, and she is the portfolio manager for Ariel Investments. And one of the things, this is the information that I gathered from her. The first thing, one of the bullish aspects of Munich RE is going to be the fact that it actually profits from climate change. Her point was that climate change increases catastrophes. The reinsurance companies, they reinsure, they offer insurance or participation insurance on catastrophe-related circumstances. And that's actually been increasing quite a bit. Between 1900 and 1950, the first half of the 20th century, we really saw about 20 natural catastrophes a year. But think about this, friends. From the 2000s on, we've seen between 300 and 350 natural catastrophes a year. Now, I don't know about where you are in the world, but I live in Houston, Texas, and I live on what's called a 400, I believe it's actually a 300-year floodplain. That means that experts estimate that there's going to be a flood in this area once every 300 years. It's been amazing how almost every year for the past 5 years, we've had a flood on the 300-year floodplain. And reinsurance companies are actually making significant profits off of that because the frequency and the severity of catastrophes are rising. And that's potentially a good thing for the profit, the bottom line of the reinsurance companies like Munich RE. Now, other analysts out there are saying things like this, that Munich RE is one of the most conservative reinsurance companies that exist. They have a great reputation. They focus on innovation, which is different. If you go to their website, you're going to see that they have a lot of innovative technology that they utilize in offering reinsurance and also in their company Ergo. They actually have 5 different companies under Ergo, and one of them is a company that specializes in online insurance. So they have a lot of insurance that's being offered in innovative ways. Ergo is actually, it's not been around in total as long as Munich RE, but they are making strides. They're actually earning more than their cost of capital. When I talk about that, what I mean is this. If you have a life insurance company, you sell a life insurance policy, it actually takes about 5 to 7 years for the insurance company to actually make a profit. And with Ergo, they are making profits. They're making profits over top of their cost of capital, which is an important thing. Now, there's no company that's perfect, and Munich RE is not perfect. They have circumstances which are going to be considered bearish. Munich RE does not have a strong competitive advantage. But you have to remember, I'm going to counter this by saying that this is an oligopoly business. That means that there's not a lot of companies like that. Yes, they don't have a big advantage over companies like Swiss Re. And in a few minutes, when we look at the competitiveness of these companies, you're going to see that they're pretty close in what they do as far as performance goes. Another bearish sentiment is going to be that they have a lot of divisions in their company. They actually, in Munich RE, there are 4 different separate companies that exist. In Ergo, there are 5 different companies that exist. And then they have one company that manages the assets for everything. There's a lot of confusion out there sometimes. And the bears, as far as analysts goes, the bears are saying that it's too complicated and there's a lot of room for improvement. And I would kind of agree with that. The losses from cancellation insurance are significant. Now, this is what drove Munich RE to withdraw its guidance for 2020. They have an estimated 800 million euros in losses that will be from cancellation insurance. Cancellation insurance is something like a big convention that was scheduled to be at a big convention center cancels. Well, they reinsured in the cancellation insurance and they have to pay up. There's different circumstances like that that are occurring all over the world, but those are not going to be a permanent circumstance. Things like this happen, and that's the reason why that they have their reserves, and they still have reserves that are close to around 200%. So I would counter it from that standpoint. Now, what's a fair price on this company? It's being beat down a lot right now because of what's going on with the withdrawal of the guidance, and basically because of the reinsurance market itself is under pressure because of what's going on with the pandemic. But if we look at the current price, which is at about $26.86 today, it actually ended at $26.95. Morningstar's analysts, and they do have a group that actually looks at this, and they're pegging the fair market value right now at $30.75. So their opinion is going to be that this company is about 13% undervalued. When we look at how that compares over previous years, we're pretty close to what it has been in the past. If you're just listening, what I put on the screen is a graph that shows what the fair value is, the estimates, and then the actual values. And you're going to see that the red line is pretty close to actually where the market value is on a regular basis. And I think that's where we are right now with Munich RE. So how do they compete? We've talked about the stability. We've talked about the earnings. So how did this company compete? They compete with companies like Hanover. And if you look at the spaghetti graph that I put up on here on the screen, you're going to see the past year. And what you're going to see is that Munich RE competes very well. In the past year, they've actually done better than most reinsurance companies that are out there. Hanover is another one. Swiss Re is another one. Renaissance, and then Everest Re is a competitor too. Remember, this is an oligopoly business. There's not a lot of companies out there. And if you're looking at the spaghetti graph, you're looking at a lot of them that are moving in a correlated fashion. So they've actually done pretty well from a competitive standpoint. Now, what are some of the actual analysts saying that are out there? What I put up on the screen at this point is going to be a list of all the different analysts and what they have said. And you'll notice there's no numbers on this page. All they're doing is they're saying reiterate, hold, buy, outperform. So let's break this down just a little bit and see what it says. There are two companies that have actually just put a hold on this. In other words, they're not adding, they're not selling, they're not buying. That's Deutsche Bank and Societe Generale. Those two companies have put a hold on it. There's only one company that says that Munich RE is set to underperform the market, and that is Credit Suisse Group. As far as companies that are saying that they look for Munich RE still to outperform the market, Smith Barney, Royal Bank of Canada, Barclays, Morgan Stanley, all of those companies have put either buy notices out or outperform notices. And I think when you put all that together, that'll help you to decide whether this is a good stock that you could put in to your portfolio or not. I think if you're looking for dividends, this is a great stock to consider. And that really brings me to the final thing that I want to say, which is when we look at stocks, we continue to look at the stability, the earnings, and the competitiveness. So I hope that that's been helpful to you. I hope that it's been a good information for you. Edward, thanks for listening and all your great comments. And Thomas, that's listening in Bavaria, thank you for watching today too. No matter where you are in the world, I am so happy to hear from you and hear your opinions on what my opinions are. And I hope that I've been able to share some information with you today that's been helpful. This has been a little different than what I normally do. It took me a little longer to put this together, and I hope that it was helpful to you. I'm going back over some of the comments that you've sent over to me in the last few days, and I'm trying to ascertain different investments to take a look at. So give me a little time on it. If you have a new investment that you want some opinions on, go ahead and list it, and I'll go ahead and see if I can look it up and help you out with it. So remember, at the very end of today, you need to listen to the disclosure or watch the disclosure because there are limits to what I can help you with. Thanks a lot, friends. And I appreciate everything that your comments. Edward, thanks a lot. I appreciate all your comments and those that follow me. Thanks a lot and have a great day.